Welcome to the February update for the How to Invest HQ portfolio. In this quick video, I'm going to give you a brief introduction to the portfolio if you aren't familiar with it. I'm going to discuss the latest purchase of the portfolio, and I'm going to give you some reasoning why I chose this particular stock. And the goal of this project is just to help individuals pick better stocks and feel more comfortable picking individual stocks rather than just sticking to the mutual funds or other types of investing. And if you're not familiar with this portfolio, I started it back at the beginning of the year, January 2014, and it's just a small stock portfolio that I'm publicly displaying on my site. It's completely transparent. These are real positions with my own money. And I'm planning on adding just $500 to $1,000 a month to the portfolio with the initial plan of investing in 5 stocks and then adding to these positions over time. And it's meant to show a home-based investor how to not only pick stocks, but how to add money to your current positions over time in a way that makes sense. And I want to give these monthly updates, quarterly and annual as well. And the quarterly and annual will focus more on performance and overall plan for the next quarter and the next year, whereas the individual videos will focus on where I put the that month's contribution and why. Even though I hope the portfolio does well, follow along at your own risk. Don't use money that you need for anything in particular, and don't invest everything. That's for sure certain. There's always a risk in holding stocks. And just a quick update on our previous holdings. Since the portfolio just started, I only had one other stock, and that was the first month's purchase of 5 shares of LinkedIn. It's LinkedIn.com, the professional social network. And I got that at $200.66 in early January 2014. And currently that's valued at $215.40, which is a nice gain, but it's nothing to celebrate. With this portfolio project, we're interested in big long-term gains. 7% in a month is nice, but I'm not concerned about the month-to-month variations in price. I'm concerned about the year-to-year variations in price. This is a long-term investment. LinkedIn is very volatile. It goes up and down by 5% in a single day all the time. So a 7% gain now means nothing. And really, gains on paper are not the same as money in the bank. I'm up 7% today, but tomorrow I could be down 10%. The stock moves quickly. So it's nothing to worry about over the short term. And the goal with this stock was to purchase at 200, and I hope in a couple of years, maybe up to 5, that it's worth 400. That's the goal here. We're looking for a big gain over a long period of time. And that brings me to my February 2014 purchase. I purchased Potbelly Corporation, which is the popular sandwich shop, and that's NASDAQ symbol PBPB. I grabbed 44 shares at $22.50, and the stock did dip to an all-time low of $21.70 afterwards. I bought it very early in the day, and it slowly dipped down. I could have waited and maybe got it at a better price, but really hindsight is 2020. You can't beat yourself up for missing by a couple percentage. Nobody predicts the bottom perfectly, and it could go down more. And if this stock was to continue to track down for a little while, I could always buy more at that lower price. If I bought another $1,000 worth of stock at $20 a share, that would bring my average purchase price down to $21.25, which lets you own a stock at a theoretically cheaper price, even if you bought before the bottom. So even though the stock dipped a little bit after I bought it, it's still a relative bargain. And the reason I say that is because $21.70 is the 52-week low, or it hit the 52-week low during trading day at $21.60. This is the lowest the stock's ever been. It just went public in October of 2013, and it's coming off a high of $33.90. So the company has not changed since October 2013. They had a decent quarter. They built locations, but investors thought, hey, maybe we valued this too highly. Let's get some of our money back. Let's sell out while we're ahead. And as a result, the stock dipped, 33%. And I'm happy to buy it at 33% off. It's still a good company. And I think they're going to grow into this valuation and beyond in the years to come. Again, this is a long-term investment. I'm not looking at Potbelly, for the dollar gain. I want $20 gain on this share price, or 40 or 60 over, a long period of time. That's what we're going for. And why I picked this company. One, this is a great fast casual food company, and that's a space I want to invest in. This is what's called a secular growth trend. It's a trend that's growing in spite of economic conditions. Chipotle was able to grow during the recession. Panera grew during the recession. These fast casual restaurants, which are producing theoretically fast food, but of a much higher quality at a slightly higher price, are that's what's really trending. That's what people are interested in. That's what consumers want. They want to pay $1 or $2 more for their meal to have a much better meal. And the reason there's such a difference in quality with that little bit of difference in price is that a lot of the cost of getting food out is staff and location. McDonald's has to pay a large number of staff, and it's selling sandwiches for a couple bucks each. So when you add $1 or $2 to that can go all to the ingredients, and that really makes a huge difference in quality for not much price. And people like this. And in a previous video, I put out the target stocks that I was looking to acquire over the course of the year, or possibly looking to acquire, and I really wanted Chipotle. I've loved Chipotle for a long time. I wanted to add it as part of this experiment, but unfortunately we missed earnings and the stock's up 20% near all-time highs. That doesn't mean I won't take it later, but it's not my fast casual restaurant of choice, just because although I think it's going to be worth more in 5 years than it is today, I think there's time for it to pull back or at least consolidate before we have to enter in there. So I really don't want to own Chipotle at this current price, but in 3 months I'd buy it at this price. In a year I would definitely buy it at this price, and if we can get it lower, I would take it as well. So I chose PB instead because it's cooled off in price, and it's down 33% from the IPO. And I particularly like this company because not only they're a great company in a great space, which is fast casual, but they also make a lot of money and they have a lot of room for growth. Potbelly only has about 300 locations. Compared to Panera, has 1,500 locations. So Potbelly has a lot of room to grow domestically. Over 80 locations are in the state of Illinois alone. So it's a regional brand that can easily go cross country. And they grew very slowly before going public, but now that they're public, now that they have funding, and now that there's a board and stockholders interested in expansion, they're building new locations very quickly. And I think they'll be able to grow nicely. And the reason for that is this company has a 20% profit margin on its existing stores. It's a huge profit margin for this kind of company. And they've been posting positive same-store sales growth, which is the pre-existing stores are generating more money each quarter. And it's not a huge growth. I think I've seen anywhere from 2 to 6% looking through their investor materials. But that's solid at this level of profit margin, in particular this level of locations, just because they're going to be able to grow so much by just adding new locations, and they're so profitable per store that they can use their revenue from their current locations to help build and pay for new locations. So they're using revenue from current locations to pay for new locations. I just want to make that clear. And I didn't get to put it on this slide, but I think Potbelly unfairly gets lumped in with Noodles & Company just because they went public around the same time, and they're both fast casual restaurants that came around a little bit later than Chipotle and Panera, at least on the IPO scene. And the reason I think that it's not fair is because Potbelly makes money. Noodles makes not really money. I mean, they make a little bit of money, but most of their expansion is based on loans and capital. Potbelly can build its own new stores based on money its previous stores are making. Their little bit of fundraising from this IPO is going to give them all the money they need to jumpstart their business, and they can just use their existing locations to fund future expansion. 20% profit margin. There's a ton of money to put into 10% new stores each year, and that's what they're shooting for. So they're looking to put up 30 locations this year, and I think that's great. If they can do that, they can maintain 2 to 5% same-store sales growth. They're going to be growing quick, and that's what I'm interested in. And another reason I like Potbelly over Noodles is I just think Potbelly has a better product. One, I think there's more room for sandwiches to grow than Noodles. And two, I think their product's just a higher quality with a broader audience. Noodles, I've done a little experiment. You go and sit in one, and most everyone that eats there is female or a child. And not that there's anything wrong with that, but it just really limits the growth potential of Noodles as compared to a place like Potbelly. It's like both of these companies really rely on work lunch crowds. So when lunch crowds are mixed, they don't go to noodles. They go to Potbelly because everyone can eat a sandwich, but not everyone's going to eat. And the noodles are really pared down, kind of light fare that noodles provides. So for those two reasons, I really like Potbelly more. They make money. They've got more potential to expand. That's the bottom line. So I hope this video was helpful. Subscribe, and every month I'm going to put out a video like this at the beginning of the month, detailing how my previous positions have done, and what I'm looking to do for the next month, or what I've already done. This is an active move. I've already bought this stock, so feel free to follow along, check out the blog, subscribe for more updates.